All right, guys, let's start. Okay. So today we are doing your chapter number 3 of your investment management, which is alpha and the low risk anomaly. Right. This is from book number 5, risk and investment management. There are 3 modules here: module 1, module 2, module 3. Right. Module 1 is about low risk anomaly, alpha, and the fundamental law of active investment. Module 2 is about your factor regression and portfolio sensitivity. Module 3 is about time varying factors, volatility, and beta anomalies, and anomaly explanation, right? So if you see here, there's a lot of kind of word anomaly which is discussed, right? If you pay attention, right? So what is happening here is that we are talking about low risk anomaly, right? Again, same low risk anomaly coming here. Then we are talking about anomaly explanation, anomalies, beta anomalies, right? Factor regression, portfolio sensitivity. So a lot of buzzword, right? A lot of buzzwords which you hear a lot, right? So uh, again, what students should understand here is that this chapter is really about one big question, right? That is, can your investors, right, earn abnormal returns, which is also called alpha, right, in a way that traditional theory does not fully explain, right? That's why it is called anomaly, right? The low risk anomaly is important because it challenges one of the most basic ideas in finance, that higher risk should give you higher return, right? But in practice, what we have seen is sometimes low risk stocks outperform higher risk stocks, right? Which is very surprising, right? So why this matters in your FRM part 2? Because this topic, right, links your investment management with the risk management, right? Portfolio managers care more about your alpha generation. Risk managers care about whether your returns are coming from your true scale, yeah, your hidden factor exposures, your leverage limits, your behavioral biases, your model failures. So FRM, right? FRM part 2 is trying to do a connection here, right? This chapter connects very strongly to what you have read in FRM part 1 also, like the CAPM and the multi-factor model, right? And your performance attribution, your Sharpe ratio, your information ratio, your active versus passive management and factor risk, portfolio construction and benchmarking, right? So this is a topic not about your investment, right? This is not just an investment topic. For a risk manager, the low risk anomaly raises a very key issue. Are we measuring the risk correctly if high risk assets do not reliably earn your high return, right? This question is central to your modern kind of risk management. Okay. So that is what we need to understand here. Okay. So let's get started, guys. I think very interesting chapter coming your way, right? So in this one, there are again model 1, which low risk anomaly, alpha, and the fundamental law of your active investment. There are 5 subtopics here, right? So low risk anomaly, topic number 1, alpha and tracking error, information ratio and Sharpe ratio, benchmark selection for alpha, fundamental law of active management, right? So what each topic means is, when you talk about low risk anomaly, we are asking a very specific question here. We are asking that why do your low beta or low volatility stocks sometimes outperform, right? Low risk anomaly, right? Then we are going into alpha and tracking error, which is if a manager deviates from the benchmark, right? That creates your active risk, right? Alpha is your, you know that, right? Alpha is your return beyond what the benchmark or the factors would predict, right? Then we go to information ratio and Sharpe ratio. Sharpe ratio is what? Sharpe ratio is the excess return, right? Excess return per unit of total risk. Total risk. Sharpe ratio was for total risk. Information ratio is the active return per unit of tracking error, right? So Sharpe is more absolute portfolio efficiency, while information ratio is more your skill related to the benchmark, right? Then we go to the benchmark selection for alpha, right? Alpha depends on what benchmark you compare against. A bad benchmark can create fake alpha and hide your true alpha. And then there is a fundamental law of active management. This gives a framework for how active managers generate your value, whether it is skill, whether it's number of independent bets, whether it's the efficiency in converting your forecast into positions. So if you look at the connection in the FRM, right? So this module is blending a lot of things here, right? It is blending your market race, this is blending your portfolio performance measurement, this is kind of blending your manager skill evaluation and the model risk. A risk manager should always ask, is the alpha real or is it just compensation for some overlooked kind of exposure, right? So that's what we need to understand. All right. Okay. Now we go into depth, right? We try to go into depth of what each topic means. First topic is simple, low risk anomaly, right? This is a core concept. Let's try to break it down, right? So we understand the traditional finance view, which is the CAPM, capital asset pricing model, which you studied in FRM part one also, right? So CAPM predicts a positive relationship between beta and the expected return. Makes sense, right? Higher beta is higher expected return. Why? Why do we have that? Because beta measure exposure to systemic market risk. An investor would be compensated for bringing or bearing that risk, right? So under CAPM, high beta stocks will outperform low beta stocks over time. Low risk stocks should earn low returns, right? Now, what the anomaly says, right? What exactly is the anomaly, right? The anomaly says that in practice, the opposite has been observed, right? That lower beta stock, lower volatility stocks have sometimes, not always, have sometimes produced higher risk adjusted and in some periods even higher absolute returns than your riskier stock. That is a low risk anomaly, right? Why it is called an anomaly? Because it contradicts the standard prediction of your CAPM, and the important nuance which students of FRM should understand is that please do not interpret this too simplistically, right? This anomaly does not mean that risk does not matter. This anomaly does not mean that low risk stocks always win. This anomaly does not mean the CAPM is useless, right? It means beta alone, beta alone may not fully explain your returns. Market may be affected by your constraints or your preferences or your behavioral biases, and there are other factors beyond your market beta which matter, right? This is exactly why your FRM part two spends so much time on your multi-factor kind of thinking, which is being done here, right? And the evidence is also given on the slide, right? So the slide gives you a very clear example that a low volatility ETF had cumulative return around 68.75% compared with about 65.27% for the S&P 500 ETF, right? Over a 5-year period from 2011 to 2016, right? And how do you interpret this? This is just one illustration, not a universal law. That the real lesson here is that empirical evidence often shows that low risk portfolios, empirical evidence often shows that low risk portfolios can compete with or outperform your broad market portfolios. For FRM purposes, focus more on the conceptual challenge to the CAPM than the exact number. And why might the anomaly exist? Even though this slide doesn't list the explanation yet, right? But it's useful to kind of understand it, right? So there are leverage constraints. Some investors cannot borrow easily. So instead of leveraging your low risk asset, they chase high beta stock to boost expected return. This can make high beta stocks overpriced and low beta stocks underpriced. There are behavioral biases also. Investors may prefer lottery-like high volatility stock, pushing prices too high and future returns too low. And there is benchmarking and agency problem also. Asset managers may prefer high beta names because they can help beat a benchmark in your bullish market, even if long run risk adjusted returns are kind of worse. These are all highly relevant in your risk management because they show how your institutional frictions distort your market outcomes, right? Now, if you want to look at this from the risk management relevance, right, what is important to understand is that this matters in your real portfolios because risk manager must distinguish between volatility as a risk metric, true economic risk, pricing distortion, your factor crowding, right? A low volatility strategy may look safer, but it can still have risks like your sector concentration, your valuation risk, your interest rate sensitivity, your crowding risk, your drawdown risk in your certain regime. So risk management is never just about buy the low volatility stocks and relax, right? So overall, I think it's a very interesting topic. The low risk anomaly teaches us that simple models are useful, but real markets are shaped by frictions, your incentives, your investor behavior, your behavioral biases, and this is a core FRM thinking which they want you to develop, right? So this is what we are talking about here. Okay, I think I've explained you quite a lot, right? All right, much more than which is given in the syllabus, right? If you look at the practice question, which of the following statement is correct concerning the relationship between the low risk anomaly and the CAPM model, right? So if you look at carefully, right, the low risk anomaly provides support for the CAPM. No, not at all, right? The second one is the notion that the low risk anomaly violates the CAPM has notion that the low risk anomaly violates the CAPM has not been proven empirically. Not exactly correct, right? The notion that the low risk anomaly violates the CAPM has not been proven in empirical, no, but there was empirical data, right? The low risk anomaly violates the CAPM, that's okay, and suggests that low beta stocks will outperform high beta stocks. Yeah, that's what the empirical evidence showed us, right? Both CAPM and low risk anomaly point to a positive relationship between risk and reward. No, not at all. So answer is C. So basically, CAPM says, right? Please keep in mind, CAPM says higher beta high expected return. Low risk anomaly says something else. Low risk anomaly says that lower beta, lower volatility can outperform. So the anomaly is directly inconsistent with your kind of your CAPM prediction, right? If you look at other options, option A, which was the low risk anomaly provides support for the CAPM, wrong. It does not, right? It does the opposite, challenges the CAPM, right? The notion that the low risk anomaly violates the CAPM has not been proven empirically wrong. There is substantial empirical evidence documenting the anomaly, even if debate remains about its exact causes. And if you look at option D, both CAPM and the low risk anomaly point to a possible relationship between risk and reward. Again, wrong, because CAPM says positive relationship. The anomaly says the relationship may be flat or even reverse in some setting. For FRM, please keep in mind that the CAPM prediction is expected return arises with your beta, low risk anomaly evidence. If you look at low beta, low volatility portfolios often do unexpectedly well. This contrast is exactly what the exam wants you to recognize, right? So keep that in mind. Okay. All right. I think solution wise, we have done a great job. So I'll not repeat it. This is what we have discussed, guys. So this you can read in your spare time. Okay. Okay. Uh, Overall, what you need to keep in mind, right? Why this low risk anomaly, before I go ahead, right? Why this low risk anomaly matters for your risk manager, right? A risk manager should immediately ask a very clear question, right? Is this outperformance due to a hidden factor? Is the benchmark appropriate? Is the alpha or just the exposure to another rewarded factor? Is the strategy crowded? Does it fall in the stress regime? So that's how it's linked to your other FRM part two topics, right? The factor model, there is benchmark choice, there is tracking error, there is performance attribution, there is portfolio construction, there is limit of equivalent model, right? So the core idea which should be built here is that CAPM says more systematic risk, more expected return. Low risk anomaly says in reality, low risk stocks often do better than CAPM predicts. And why it matters? Because this challenges your traditional theory and opens the door to your multi-factor models, open the door to your behavioral explanation, open the door to your institutional constraints, open the door to your more careful performance measurement, right? So think of risk, a low risk anomaly as a kind of a warning, right? The risk measured only by beta. Risk measured only by beta is not enough to explain your real world returns. And that is why, exactly why your modern risk management uses broader factor analysis, benchmark relative analysis, active risk measures, deeper model validation, right? So all those things. Okay. All right. With that, we go to the next topic, right? Which is your alpha and the tracking error, right? Alpha and the tracking error. Okay, when you look at alpha and the tracking error, basically, first we need to understand what is alpha, right? So alpha is your return above a benchmark, also called your active return. Formula is excess return, which is RT minus RTB, right? Uh, Intuition here is that benchmark, what you could get passively, alpha is what you earn because of your skill or the luck, right? So let's say there is a portfolio return of 12%, the benchmark return is 10%. So alpha is plus 2, right? So very important to understand here is that alpha is sometimes misunderstood also, right? Alpha is not absolute, right? Depends on the benchmark. So you change the benchmark, change the alpha. This becomes critical later when a lot of other topics will come, right? Topic number 4, which will come later, right? So investor skill is the subtle point here. Alpha is often interpreted as skill, but when we add the nuance of the FRM, right, why we are studying this, right? Alpha is a performance related to the benchmark. It may reflect skill. I'm not denying that, right? But it also reflects your factor exposure. It also reflects your luck. It also reflects your wrong benchmark, right? Risk manager mindset is this true alpha or this is hidden beta, right? So tracking error, if you look at the definition, tracking error is the standard deviation of excess returns. Tracking error is equal to sigma RT minus RTB. What it matters is it measures how much the portfolio deviates from the benchmark. The intuition for tracking error is think of tracking error as how different is the manager from the benchmark. If you have low tracking error, very similar to benchmark, your closet indexing. If high tracking error, you're very active bets, right? So key FRM idea here is that alpha is the reward, tracking error is the risk, active risk. So active management is about taking tracking error risk to generate your alpha, right? So in risk management, if you have high tracking error, it means your higher model risk plus your active risk. If you have low tracking error, it means risk of fake alpha, which is like fees for your passive behavior, right? Which we need to understand. Okay, so a lot of points here. I've explained them well, but you have to remember the especially tracking error, measure the dispersion of investor return. A large tracking error indicates more freedom in decision making, right? Okay, and once we have seen that, we go to the next one, which is your information ratio and your Sharpe ratio, right? See, information ratio you have studied in FRM part one also, right? Information ratio, when we talk about, right? Information ratio is basically your alpha divided by tracking error, but it means the return per unit of active risk. Think of how much alpha per unit of deviation from the benchmark. Why your information ratio matter? Because it is used to evaluate your active manager, used to compare your strategy. Interpretation is higher interest, higher information ratio is better skill per unit of risk taken, right? Sharpe ratio is something else which you have studied. Sharpe ratio is your RP minus RF by your sigma P, right? What it measures is excess return per unit of total risk, right? The key difference is in Sharpe ratio, we had, the formula you can see the benchmark is risk-free rate, risk is used sigma P, total volatility, use cases, your overall portfolio efficiency. When we go to information ratio, you see the benchmark here is market or the benchmark. This used is tracking error, right? And it is for active manager skill, right? So from the FRM perspective, Sharpe is more about is the portfolio good overall. Information ratio is the manager adding value or benchmark, right? Uh, Versus the benchmark, right? So risk management skill is Sharpe used in portfolio optimization, IR used in manager evaluation, performance attribution that we need to keep in mind, right? So very, very important to understand. Then we look at your benchmark selection for alpha. This is again very, very important topic, conceptually very important topic, right? What is happening here is that there's a core idea. Alpha depends heavily on the benchmark which is chosen, right? So wrong benchmark is leading alpha. There's a beta problem also when the slide is mentioning here, right? Benchmark like S&P assume beta is equal to 1. But your portfolio might have beta is equal to not equal to 1, right? So why this matters is because if let's say portfolio beta is 0.73, benchmark assumes beta is equal to 1. So you're comparing different risk level, right? So alpha gets miscalculated, right? And from the FRM interpretation, this is a model risk issue, misspecified benchmark leads to your incorrect performance measurement. If your portfolio is having lower risk than your market, then you should expect lower return. But if you compare to full market, right, you might wrongly conclude low alpha, right? And when you look at the characteristics of your of an effective benchmark, right? It's well defined. There are clear rules, no ambiguity. They're tradable. Can actually invest in it. This replicable, can be realistically copied, risk adjusted. Most important, same risk level as your portfolio. And there's a risk management connection also here, right? Because see, benchmark selection affects your alpha. Benchmark selection affects your uh, information ratio. Benchmark selection affects your performance attribution. Benchmark selection affects your composition decision. So this is all about your governance risk, right? So please go and read about it. Impact of alpha, the beta problem. I told you this one example, well-defined, tradable, replicable, risk-adjusted. All these are points. I've added some extra points also so that you have a comprehensive understanding. Go back and read about it. So now we read the question, which of the following statement is not what you're talking about, not a characteristic of appropriate benchmark. An appropriate benchmark should be what? Now, if you look at basically we are looking not, right? Looking at not means we're looking at the wrong answer. Appropriate benchmark should be actually tradable, right? But we are looking for not. So this gets cut. Applicable, yes. Well defined, yes. Equally applied to all risky asset, irrespective of the risk exposure. No, we don't want equally applied, right? So this is D the answer. Let me explain it, right? See, why D is wrong, right? And we are looking for the wrong answer. So this is the correct answer, right? A good benchmark must match the risk profile, right? So not all assets have same beta, not all assets have same volatility, not all assets have same factor exposure, right? So why others are correct? Because tradable, replicable, well-defined, these are your standard benchmark properties. If you see same benchmark for all assets, obviously that is wrong, right? Almost always wrong in FRM, right? So that is what we need to keep in mind. I think pretty straightforward if you understand the properties, right? So this is done. You can read the answer. We are going to the next topic, which is your topic number 5, which is fundamental law of your active management, right? When you talk about fundamental law of active management, please understand this again, very interesting. This is Reynolds' fundamental law of active management. The law is very clear. Information ratio is equal to IC into your root of BR, right? What is IR? IR is information ratio, right? Information ratio gives you what? It gives you your performance measure, right? Then we have IC. IC is what? Information coefficient. What information coefficient gives us? Information coefficient gives us the idea about skill. What it tells you? It tells you the correlation between your predicted and the actual outcome, right? The correlation between a manager's predicted value and the actual value. It's an explicit evaluation of forecasting skill. A higher IC means higher quality predictions, right? And better forecasting ability. Higher IC means better forecasting ability. Then we have BR. BR is breadth, right? Root of breadth, right? So it is the number of independent investment bets deployed, number of independent bets, more bets is equal to more opportunity. The big intuition here is, right, you can succeed in two ways. Option one is you have high scale, which means high IC if you're bets, but very accurate. Option two is high breadth, which is obviously high breadth, many bets, average accuracy. The key trade-off, right? The key trade-off is you need to play smart, IC versus play often, which is BR, right? An important assumption here is to that bets are independent, ignores your downside risk, right? So remember that, because in reality, bets are often correlated. So breadth is kind of overstated, right? And there is a limitation also, very, very important, because this comes in exam. You know that assumptions and limitations are tested in exam a lot. So limitations very important. As fund size increases, harder to find opportunity. IC tends to fall. That is why large funds outperform, and some funds close to new investors, right? That's the whole logic, right? From the FRM perspective, what you need to keep in mind, right? So I'm just giving you overall picture, right? This connects to your capacity risk, your crowding risk. There is something called your model decay or factor overcrowding, right? Which you should keep in mind, right? But not part of the syllabus here. All right, we move to the next part, right? Which is Reynolds' fundamental law of your active management suggests what, right? So let's look at the options. Option A, investors should focus on increasing only their predictive ability related to stock price movement. No, ignores the breadth, right? So goes away. Sector allocation is most important factor in your active management, not part of your Grinnell's law of active management, right? A small number of small number of investment bets decrease the chance of making a mistake and therefore increase the expected investment performance. See, fewer bets improve your performance. It is very opposite to what we have studied in theory. So this goes away, right? And if you look at now the option D, right, to maximize the information ratio, active investors need to either have a high quality predictions or place a large number of investment bets in a given year. That makes sense. This is what the Grinnell active log investment management is. You maximize your IR either through high IC, which is your one of the factors, which is focus on your scale, or high BR, which is more bets, right? So the law clearly states performance improve with both scale and number of independent bets, which you need to keep in mind. That's why IC and BR both are important. And from this, till now, right, what we have studied, right, we are able to capture something very powerful, that alpha is what you earn beyond your benchmark. Tracking error is risk taken to generate your alpha. You have information ratio, which is efficiency of your active management. Benchmark choice, which is determining whether alpha is even real. Then the fundamental law explain how alpha is generated, right? Overall, if you think about a risk manager perspective, risk manager should always ask, is alpha real or benchmark driven? Is risk measured? We have, total risk or not, right? Is performance due to your skill or excessive risk taking? Are bets truly independent? So that's what we need to understand very, very holistically. Okay. All right. So this is, we have already covered, right? We have already discussed the solution. You can go back and read it. I'll quickly move ahead. Okay. Now I go to your model 2, right? So we have completed model 1. We are going to model 2, right? So what this model is about, we are looking at your factor regression and portfolio sensitivity. Factor regression, portfolio sensitivity, all new buzzwords coming your way, right? factor regression portfolio sensitivity, you're moving from your simple CAPM world, right, which had one factor, to multi-factor model, which was more realistic. So topics here are CAPM regression, which is single factor, pharma French, which is multi-factor, momentum plus model limitations. The big FRM idea here is returns is equal to alpha plus factor exposure plus noise. So instead of saying manager generated alpha, we ask, is this alpha or just your exposures to your known factors? Then we have risk management relevance. Also, we have to understand that this module is trying to help us answer what risk is the portfolio actually taking in the performance due to your skill or the systematic factor exposure, right? So a lot of things coming your way. Factor regression to construct a benchmark, factor regression to construct a benchmark, pharma French three-factor model, momentum factor, and the challenge of using the pharma French model, right? So this all three we are trying to figure out. Okay. All right. So now we're looking at factor regression to construct a benchmark, the CAPM model. So the core regression equation here is that you have to look at the meaning of each term. One is the asset excess return, one is the market excess return, one is the sensitivity to the market, one is the unexplained return, skill or mispricing, right? So the key insights which you are getting here is that factor regression can be applied to construct a benchmark multiple factors, extending the CAPM. Your CAPM based regression, RB is equal to expected return, RI is equal to RF plus beta, ERM minus RF, RB is equal to 1 minus beta, RF plus beta, ERM, right? So what is happening here is that regression builds a benchmark, right? So that's what we are looking at. RB is equal to 1 minus beta, RF plus beta expected return on the market, right? So your benchmark is partly risk-free asset, which is 1 minus beta RF, partly market portfolio, which is beta into expected return on the market. This is your custom benchmark construction, right? Custom benchmark construction. Why this is powerful? Because see, instead of blindly comparing to S&P 500, right? You are building a benchmark matching your actual risk exposure, and you know you are using, let's say, if you see here, using regression alpha is approximated by regressing the excess return of the asset RIT minus RF using the excess return of the market RM minus RF. So RIT minus RF, which is the alpha, right, is equal to what we are doing here is approximated by regressing the excess return of the asset RIT minus RF, right, against the excess return of the market, right? So okay, if this is becoming confusing, let me take a simple example, right, which is given here also, right? So what we are saying is that if you take a Berkshire Hathaway example, right, alpha is 0.72 per month, right? Right, beta is your 51, right, 0.51. So portfolio is less risky than your market. Benchmark should be 49% risk-free and 51% market, right? So the key idea here is that if you compare your Berkshire to S&P 500 directly, that's a wrong alpha. If you adjust for beta, that's a true alpha, right? So risk manager should have a clear perspective. You have to understand that your what you say very clearly that we are trying to solve for your benchmark misspecification or false alpha detection, and that's the whole thing, right? This analysis was conducted for Berkshire Hathaway related to S&P 500, and regression yielded this. Regression implies the CAPM equation as this. Alpha came out this. So this is what we are trying. That don't directly jump to the conclusion that S&P 5. You should always compare to the standard benchmark of S&P 500, right? You can create your custom one also, right? So that's the whole idea, that if I have to, first you create your own benchmark, which is you don't have to always look at your S&P 500, and then you find out your alpha, right? Once you have this own benchmark which has been constructed here, then you find out your own alpha, right? And then you say that, okay, fine, my alpha will depend on this, right? So overall idea is very simple, that if portfolio is less risky than the market, benchmark should be 0.49 RF, risk-free asset, 0.51 risky asset, And if you compare Berkshire to S&P 500 directly, you will be getting the wrong alpha. If you adjust for beta, right, then you get the true alpha, right? So that's what we are talking about. Okay, that's the whole idea of factor regression to construct a benchmark. Okay. Then we go into the next part, which is factor regression to construct a benchmark pharma French, right? We are getting to the next model, pharma French three-factor model, right? So we are extending the CAPM, right? We are saying that CAPM is not enough. CAPM assumes only market risk matters, but empirically often there are other patterns also exist. Two additional factors which you studied in FRM part 1 also. One was the size effect, SMB, one was the value growth effect, HML. SMB is small minus big, large or long, small cap stocks, minus your short, large capture your size premium. HML is your value factor, high minus low, long value stocks, high book to market, minus your short growth stocks, capture your value premium. And then we look at the full model, right? When you look at the full model, which is your RI minus RF, alpha plus beta I market into RM minus RF plus beta I SMB into SMB plus beta I HML into HML, right? So what is the interpretation here is each beta tells you a kind of exposure. There's a market exposure, there is small versus large bias, there is value versus growth bias. And if you look at from the FRM perspective, instead of saying manager is kind of great, we say manager is tilted towards your small cap and your value stocks. And your risk management idea here is that this helps us in understanding your factor risk decomposition, your style analysis, your portfolio sensitivity analysis, right? Very, very important. It's an extension of what you learned in FRM part 1. So again, I don't think this is something new. This is a repetition of what we have done earlier in FRM part 2, right? So keep that in mind. Part 1, right? So that's FRM part 1, chapter number 6, book number 1, right? So this is an extension. We are going into example now. This is where things change a little bit. So what changed versus CAPM here? Again, Pharma French model was applied to Berkshire Hathaway, January 90 to May 2012. Data is given below, 87.2. Right. Alpha slightly decreased. Beta increased from 0.51 to 0.67. SMB, small minus big, beta negative, large cap bias, HML, beta positive, value investing. The key learning here was very clearly that adding factor reduces your fake alpha, improves your model accuracy. You have adjusted also, adjusted R square, change from 0.14 to 0.27. What does that mean? Indicating the SMB and HML factors add explanatory value to the model. These results enable construction of a custom benchmark for Berkshire Hathaway. And this is what are the numbers, right? So model explains more variation returns. The big takeaway, right? The big idea here is the sum of Berkshire alpha was actually your factor exposure. There's a custom benchmark becomes kind of richer. Now your benchmark includes your market, your size, your value, right? So this is what it is, right? Your market, your size and value. This is custom benchmark, right? And again, from FRM perspective, it is very important to understand that alpha shrinks when you add more relevant factors. So risk implication is that poor models have overstated alpha, better models have more accurate risk attribution, which you need to keep in mind. Okay. You have to generally remember the results, right? What you have to do here. Then we go into the topic number 3, which is your momentum factor and challenges of using the Pharma French model. So momentum factor, when we talk about, please understand UMD, right, which is your up minus down. There are long winners, short losers, capture your trend following behavior. You can think of it as positive beta, momentum strategy, negative beta, contrarian strategy. You have the Berkshire result, UMD beta is equal to 0, no momentum exposure. The key challenge here is that factor replication slide kind of highlights that SMB and HML are not directly tradable. And why this matters? Because what we need to understand very clearly is that this creates a model risk, right? Factors are theoretical constructs and not always investable. So alpha depends on what factors you include. Different models have different alpha. If you look at risk management connection here, This leads to your model risk. This leads to your factor selection bias. This leads to your benchmark instability. The core challenge with the former French model is index replication. SMB HML index is created by a conceptual, not directly tradable, including only tradable security is critical because the factor chosen greatly influence the calculated alpha. Very, very important to understand. From the core results, UMD, I told you up minus down, represents trending stock minus downward trending stock. Positive UMD indicates focus on upward trending stock. Negative UMD indicates the focus on downward trending stock. And beta of zero suggests no relationship, right? So that is what we follow, right? And this is what the result is. So overall, if you see previous three topics, right, all of them had results, right, in different ways, right? This is about your momentum factor and challenges or challenge of using the Farmer French. Earlier one was about Farmer French. Before that, you moved, I understood CAPM, right? So in three ways, we saw different ways of constructing your benchmark, right? And we saw different ways of calculating your alpha also. And we saw how, first model was kind of incomplete CAPM, second model was kind of more detailed, but we are focusing on few factors. Third model was different factors we are focusing, right? So it's a focus which changes, right? So again, ultimately, nobody will tell you to construct in the exam, but it's more about if you understand the logic or not, if you understand the why certain things are in certain way. Okay. Then, if you look at why would an question here is why would an investor include multiple factor in regression study, right? See, if you have two statements here, to attempt to improve the adjusted R square measure, definitely, right? Because the adjusted R square improves when you add more factor, right? To reduce the T stat value on the respective regression coefficient. This is what we are not touched, right? So this is false, right? I'll tell you why. See, actually, when you get better model, you have better explanatory power. That kind of improves the statistical significance, right? So it is generally T stat is higher, not lower, right? It improves the T stat value on the respective regression coefficient because better model, better explanatory power often improves your statistical significance, right? So remember that, right? Only statement A is correct, right? Remember that. And if we look at it, right? So this is what has been given here as well, right? So if you pay attention here, right? Investors should consider adding multiple factor regression analysis to potentially improve the adjusted R square, potentially increase the test of statistical significance, and to search for a benchmark that is more representative of portfolio investment style, right? So that's the final result we agree on, right? Now we're going to module 3, which is the last module in this chapter. Again, I'm repeating module 2 had a lot of discussion about CAPM, your Farmer French, your momentum factors, right? But ultimately, you have to understand the core result, right? That it depends. The benchmark changes when you change the models, your alpha changes when you change the models, and how things evolve, right? So that's what we need to understand, right? So overall, right, before we even move to your module 3, right, what is the bigger picture you need to keep in mind for previous model is that we need to calculate step by step. Step one is to always look at CAPM, which covers your market risk. That is simple, but please remember that is incomplete. Then we go into your, what do you say, Farmer French, which adds size and value, reduces your fake alpha, right? Fake alpha, I told you, right? Because we realized that much of the alpha generated by your Berkshire Hathaway was due to your factor exposure, right? So if you devise your model properly, right? If you devise your model properly, it is more about factor exposure rather than alpha. So reduce the fake alpha. And model 3 was momentum and others, more realistic, but again, that increases your model complexity, right? So ultimate hack here, ultimate insight here is that alpha is model dependent, right? So risk manager should have a checklist, right? Whenever you see alpha, ask yourself that what benchmark was used, what factors were included, is alpha still present after adjustment, are factors investable? Investable is very important, right? Because if they are only theoretical constructs, those are not good, right? Is this skill on exposure, right? So factor regression converts your alpha story into risk exposure analysis, which we need to keep in mind. Okay, now we are getting into model 3, which is time varying factors, volatility, and beta anomalies, and anomaly explanation, right? So this is where things get really powerful and closer to your real markets. Basically, module 3 is telling you that markets are not static. Risk, beta, and alpha change over time. Risk, beta, and alpha change over time and sometimes behave irrationally as well, right? So let's try to dig deeper, right? So what are we studying here? There are 4 topics here. measurement of time varying exposure using style analysis, issues with alpha measurement for non-linear strategies, volatility and beta anomalies, potential explanation for risk anomaly. Let me explain it, right? See, what we are trying to understand here is we are trying to answer three big questions here, right? First question is, do factor exposure change over time, right? Yes, portfolios evolve. Is alpha always real, right? No, sometimes it's kind of mismeasured, I would say, right? Does higher risk always lead to higher return? Surprisingly, not always. That's an anomaly which we need to understand. That's why there's volatility and beta anomaly. And you have four topics: time varying exposures, which you need to understand, right? This one. Then you have your alpha measurements for your nonlinear strategies. You have anomalies, volatility and beta anomalies, and why anomalies exist, right? Potential explanation, right? So what we are moving from now with very advanced concept, we understood the static models like your CAPM, assume a stable world, right? Now we are talking about reality, right? We have a dynamic, we have a behavior, we have a constrained environment, right? That we try to understand, right? So let's go deeper. Let's try to look at a deeper thing. Okay. So the first topic here is that understanding of your time varying exposure using style analysis, right? See, what is style analysis? Style analysis, when you talk about, it's a method to track your portfolio exposure change over time, right? So unlike your pharma French, which uses your real investable assets, ETFs, right? So, unlike pharma French, which is untradable SMB and HML index, style analysis use tradable assets, right? Style analysis is a form of factor benchmarking where the factor exposure evolve over time. For example, portfolio is trained using SPY, which is basically your a kind of a factor for your market. You have SPYV, right, which is for your value. Then you have SPYG, which is for growth. And then you have core regression equation, right? So this is what you have, right? Alpha plus beta SPY, right? This is, right? An important constraint which you have to understand is that this means portfolio is fully invested, no hidden leverage, right? Very, very important. Style analysis also adjusts for the fact that factor loading betas change over time that we have discussed earlier in the introduction only, right? This formula has an imposed restriction that all factor loadings, factor weight must sum to 1. That also is an assumption. The time varying portion of this equation come into play with the respect of factor loading. This process usually estimate that incorporate information up to time t. So each month, new regression, new betas, because your fund managers, right? Your fund managers changes your positions, market condition kind of change. And then we look at real world intuition. Think of a fund in bull market, shift to growth, in downturn, shift to value or defensive. Betas are not constant. When you look at risk management link, this is used for your performance attribution, your style drift detection, your portfolio monitoring. The big insight here is that yesterday's beta is not equal to today's beta, not equal to tomorrow's beta. And that is what we need to keep in mind. Every new month, T+1 requires a new regression to adjust to factor loading. This means that the beta factor will change over time to reflect change in the real world. Okay. All right. All theory, right? All theory here. Next one is your issues with alpha measurement for non-linear strategies. This is again extremely important to understand. Why? Because see, alpha is measured using your linear regression, right? But some strategies are non-linear, option-like, right? So if your strategies are non-linear, right? For example, let's say long put option, right? Small losses most of the time, huge gains, occasionally a kind of a L-shaped payoff, right? We know what is a long put option, right? So why regression fails kind of here is because linear regression assumes a lot of things, right? So what we are assuming is linearity, which doesn't exist, right? So alpha is computed to use linear regression, which can incorrectly suggest alpha exists for non-linear strategies, like uncovered long put with L-shaped payout. False positive alpha occurs and payoff involves quadratic terms. Option like terms such as max RT0, creating significant problems for your hedge fund strategies like your merger arbitrage, pairs trading, convertible bond, in non-linear payoffs. Non-linear strategies often yield false positive alpha because return distributions are non-normal, often exhibit negative skewness, increases your left tail loss potential and thickening the middle distribution. Skewness is not factored into alpha calculation, creating measurement issues for non-linear payoff strategy, right? So what we are trying to say is that your non-linear strategy, right? Regression kind of fails, right? Because regression assumes linearity, right? But real payoff may be quadrative or maybe max RT minus zero. Result is we get false alpha. Regression says, wow, this strategy generates alpha. Reality, it's just the option payoff structure, right? So some examples are given here: merger arbitrage, pairs trading, convertible bond arbitrage, all have non-linear payoffs. There is skewness problem also. These strategies have negative skewness. These strategies are fat tails, but alpha model kind of ignores the skewness. Alpha can be illusion. Alpha can be illusion. Please keep in mind if payoff is non-linear, right? So don't use linear regression and alpha in the non-linear strategy, right? Risk management implication here is you must check if the strategy is kind of linear and are we missing kind of tail risk, right? So that is very, very important to understand. Okay. Very important. All theory, but small results. Next one is about little deeper volatility and beta anomalies. We come to a counterintuitive kind of result. So what we are trying to put across in a very simple way is that there were Hugen and Haynes 1975 found using 1926 to 1975 data that stock portfolio with lower monthly return variance experienced greater average returns than riskier counterparties over the long run, right? So the traditional CAPM model, we know that consider only the market risk, right? So what data shows us? It shows opposite. Opposite often happens, right? So low volatility stocks gave high returns, better Sharpe ratio. Higher volatility stock gave low risk adjusted return, right? So evidence was Hugen and Haynes. Then where in 1975 they clearly laid out that low variance has high returns. Then your Ang et al, right, 2006. Same thing, found a volatility anomaly using September 1963 to December 2011 data organized into equity. As standard deviation increased, average return decreased from 10% for the lowest three quantiles to 6.8, quantile 4, and 0.1 highest volatility. The Sharpe ratio declined from 0.8 to 0.0. So higher volatility led to low return, right? So initial 1970s CAPM testing found positive relationship between expected return, but Ang et al. 2006 later found high beta stocks have lower risk adjusted returns, with Sharpe ratio falling from 0.9 to 0.4. Right, the beta anomaly kind of suggested, right, that high beta stocks have lower Sharpe ratio, low beta stocks have better performance, right? That is what we learned, right? And why this is shocking? Because CAPM produce or CAPM predict, right, that beta when goes higher, return also goes higher. But in reality, beta is lower, and the beta is higher, the Sharpe is lower, right? So which kinds of confuses us, right? The key reason or the mathematical intuition which comes out here is that Sharpe ratio is return divided by volatility, right? So high beta, volatility increases a lot. The return doesn't increase proportionally. CAPM predicts contemporaneous, not predictive relationship between beta and return during the same measurement period. The challenge is that historical betas poorly predict future betas, limiting the usefulness for expected return prediction. And then we go to Buss and Wilcock 2012, found some improvement using implied volatility from option pricing model to estimate future betas over historical betas, though the beta anomaly remains primarily a challenge in reliability predicting future betas, right? So beta is kind of backward looking, unstable, poor predictor of future return. So improvement attempt was done. Used the implied volatility by Buss and Wilcock 2012. Still anomaly kind of remains. So the big idea here is that risk is not rewarded the way theory suggests, theory predicts. So keep that in mind. All theory, again, just remember the results. I think that will be fine. Right. Then we go into your potential explanations for your risk anomaly. Right. Now we explain why your markets behave this way. There is no single explanation. There is the mixture. The risk anomaly explanation involves a combination of data mining, investor leverage constraint, institutional manager constraint, preference theory. So no single comprehensive explanation exists. Data mining is not well supported as the sole explanation. The risk anomaly appears during recession and expansion across US and international stocks, treasury and corporate bonds, and its option commodity markets. Leverage constrained investor, particularly retail, unable to borrow, invest in high beta stocks for built-in leverage, bidding a price until assets become overvalued with decreased risk adjusted return, while low beta stocks have lower prices and high risk adjusted returns. Institutional manager constraints include restriction against your short selling and tracking error limits that prevent capturing perceived alpha by going long, undervaluing securities and short, overvalued ones, with changing benchmarks or tolerance bands being difficult process requiring investment committee approval. Investor preference for high quality, high beta stock, often driven by bullish expectation, beta prices, and lower future return, while creating attractive entry points for long term investors seeking lower volatility investment. And heterogeneous investor preferences and investment constraints explain part of the risk anomaly, right? When disagreement is low, with long only constraint, CAPM holds best, but high disagreement leads to overpriced investment, decrease future returns, and potential inverse relationship between beta and return. See, overall, there are a lot of theories here, right? So basically, no single explanation. It's a mix of behavioral, structural, and institutional, right? That we need to keep in mind. Investor preference is one. People like your, what do you say, high risk, not really like stocks, overpay for them, lower future returns. There are leverage constrained. Retail investors cannot borrow easily. So they buy high beta stocks to simulate leverage, pushes them up, reduces your returns. Institutional constraints, funds face no short selling, tracking error limits, cannot exploit, mispricing. Result is high beta stocks leads to overpricing. Low beta stocks are underpriced. Data mining rejected as the sole explanation because anomaly exists across your equities, your bonds, your commodities. Overall, with a lot of explanation, we come to an idea that market inefficiencies persist due to constraints plus behavior that we need to know. Okay, read the explanation, all theory. Module 3 is all theory, but it comes in exam, right? Like this. Which of the following characteristic is a potential explanation for the risk anomaly, right? Risk anomaly. Investor preference, right? This is one of the reasons, right? Investor preference is the thing, right? The presence of highly leveraged retail investor, no, that's wrong, right? Why wrong? Because retail investors are leveragely constrained. So they don't have highly leveraged kind of thing, right? Highly leveraged word is wrong here. Lack of short selling constraint for institutional investors, wrong, because there are constraints for, even though you are an institution, there are short selling constraints exist. Lack of tracking error constraint for institutional investor, wrong, right? Again, there are constraints, right? So there are short selling constraint also, tracking error constraint also for institutions. So that is what we get, right? So investor preference is the answer, right? Lack is wrong. Short selling and error constraint and presence of highly leveraged. Retail investors are not highly leveraged, right? So overall, right? So if you go to the answer now, right? Right, this is answer potential. If you go here, potential explanation for the risk anomaly include the preference of investor, leverage constrained investors that drive them to buy pre-leverage investment in the form of high beta stock, and institutional investor constraints like prohibition against short selling and tracking error tolerance bands. Remember that even though it's an institution, there are prohibitions against short selling and tracking error tolerance bands, right? Remember that point. Okay. So overall, the bigger picture which you need to take away from module 3, especially that it was the evolution from the module 2, right? Module 2 was talking about static factors or linear models. Module 3 is about dynamic exposures, your non-linearity or non-linear reality, your behavioral distortion, right? So markets are not just mathematical in nature. They are human, they are constrained, they are evolving system. And what does a top quant finance, top quant guy, a risk manager does is they always ask, are beta stable? Is alpha real or non-linear in the market? Are anomalies structural or temporary? What constraint prevent your arbitrage? So risk, return, and alpha are not fixed. They evolve, they distort, and sometimes they kind of deceive, right? So that's what you need to keep in mind. That completes our this chapter, guys. Go back, quickly revise it. You will totally understand, right? What is more important is that you understand this chapter, right? So I'll give you a quick recap before we close this chapter, right? The quick recap here is that there are 3 modules here, right? Again, low risk anomaly, alpha, and the fundamental law of active management. 5 top topics here, right? In this 5 subtopics, mostly theory that you have to remember why low risk anomaly exists, what is alpha, what is tracking error, what is information ratio, Sharpe ratio, benchmark selection for alpha, fundamental law of active management, right? So if you see here, what I'll say is that, see, topic number 2, 3, 4, you have seen in FRM part 1 also, right? So I think this one and 4, 5, right? Let's keep it 4 also, right? So these are new topics, right? So which you have to remember. 2 and 3 are repetitive of FRM part 1, just to give the context here. That's why they have been given, right? So focus on those. Low risk anomaly is important. Alpha and tracking error we have done earlier. Information ratio and Sharpe ratio, FRM part 1. Benchmark selection, you can read well-defined, tradable, replicable, risk-adjusted characteristics, please remember, right? And then we go to fundamental law of active management. This is important, right? IC into root of BR, understand this is new topic. Reynolds, fundamental law of active management, please understand this, right? Then we go to portfolio allocation and factor regression, portfolio sensitivity. This is very interesting, right? Construct a benchmark, pharma French, momentum factor and challenges of using the pharma French, right? So that is what we need to understand now, right? So this is tricky. Uh, how do you use factor regression to construct a benchmark? Very important. Then how do you construct a benchmark in pharma French? And then how do you have additional model, which is momentum factor, which kind of challenges the pharma French as well as adds the complexity, right? So construction, please understand that the Berkshire Hathaway example, that how when your actual risk is less than beta, right? That's less than S&P 500, right? Why do you need to keep a benchmark S&P 500, right? Beta is 1. You create a custom benchmark, right? So that's the whole idea. Then Pharma French also, you focus on SMB and HML, right? Then you see that, okay, you see the data from so many years and you realize that even though you focus on SMB and HML, which the Berkshire Hathaway also focused, right? Then you realize that a lot of alpha of your Berkshire Hathaway was actually a factor exposure to your beta, right? So very important understanding that you have to understand the correct alpha, right? You don't have to go to misspecified alpha because sometimes some alpha is just a factor exposure, right? Then you go to additional layer that, okay, if you change the pharma French to a momentum factor, how does the thing change? We have T stats also, coefficient also. Please understand when something is explaining more, T stats will go up, right? And then we looked at up minus down and replication core challenge also, that it should be tradable, right? So this we discussed. This is very important, right? These three are very important, right? Then we go to time varying factors, volatilities, beta anomalies, and anomaly expression. Again, very important, but here it's mostly theory, right? We are trying to understand what is style analysis, how it is different from pharma and French, right? What are the differences? What do we take in mind? And how do we construct it? What are the assumptions? What the weight should add up to, right? How the things are evolving with time, that nothing is static, right? Risk, alpha, beta, nothing is static. They're evolving with time. Every new month, what you need to keep in mind. Issues with alpha measurement for non-linear strategy. You cannot employ linear strategies for non-linear strategy. You'll get a wrong idea. You'll think, wow, that I have a good alpha, but you're applying wrong thing at wrong place, right? You're applying linear strategy in non-linear place. That's very wrong, right? You should not do that. Volatility and beta anomaly is very, very important to understand that data has been studied by Hugan and Hees, Ang et al., 1970s CAPM, beta anomaly, CAPM prediction. Buss and Wilkov also tried to give more flavor, but ultimately we came to realize that there is no single explanation, right? There is no single explanation, right? There are different reasons, right? Different theories were given, but eventually we didn't get a single reason for why this anomalies exist, right? And potential risk for anomalies is more deeper here, right? This is the data for that. We studied the data and that is the results, right? So that's what has been seen, right? So all theory here in the module 3, but you have to remember it, okay? That's it, guys. That's it. We have completed our chapter. Go back, revise it, practice it, quickly read it. You have to do it 2, 3 times, right? Otherwise, things will not stick in your head. But overall, not a very difficult chapter. You have to remember it, have a clear frame of mind while solving the questions, have a clear, and please focus on the notes, right? Notes are very comprehensive. So if you focus on the notes and remember the key points and which I have highlighted and made star mark, and once you're revising my lecture, note it down, right? Once you have done that, I think you will be totally fine, okay? All right, guys, we'll stop here, okay? Thank you. Thanks a lot.